Welcome to the BF Anderson Technical Report for June the 28th. I first became aware of the William O'Neill organization, I want to say in the early 80s. And it was a really fascinating service that the company provided. They would do back testing, and they did a 100-year study of who was the most successful investors for the last 100 years. And so he wrote a book. He also published newspapers. He put out institutional quality research, the whole deal. But William O'Neill writes here, he says, when I started investing, I made most of the same mistakes you've probably made, but here's what I've learned. You buy stocks when they're on the way up in price, not on the way down. And when you buy more, you do it only after the stock has risen from your purchase price, not after it has fallen below it. Very true. Second point, you buy stocks when they're nearer to new highs for the year, not when they're sunk lower and look cheap. You buy higher priced, better quality stocks rather than low price stocks. You learn to always sell stocks quickly when you have a small 7 or 8% loss rather than waiting and hoping they'll come back. Many don't. You pay far less attention to a company's book value, dividends, or PE ratio, which for the last 100 years have had little predictive value in spotting America's most successful companies. So anyway, it's a great book, recommended highly, and William O'Neill 100-year study is definitely something to be aware of. Now, I wanted to talk a little bit about the economy. I came across this graph last week. This is the current unemployment rate. We are currently at 3.8% unemployment. This is record-setting levels of unemployment. Now, the lowest it ever got was 1953, got down to 2.6% in 1953. Now, I was born in 1954, and I do remember that my parents really benefited from the bull market from, the 1950s to the mid 60s. The market basically went up from 1950 to 1966. So remember, we had the Great Depression, market made a top in 29, didn't really start bottoming until around 1932, didn't really recover and make a new high until around 1950. So with the unemployment rate really going down, are we possibly getting into a 1950s style of economy? Could be. Now, the other factor that is important right now is interest rates. Now, this is the 10-year Treasury yield for the 10-year Treasury bond. Now, one of the observations about the unemployment rate is that when you get down to, say, 2.6% unemployment, the major cause of inflation is higher wage rates. And so it was about a 20-year lag because we ended up with hyperinflation in the mid-70s. So, are we looking at a similar situation where we're going to gradually reinflate the economy? Well, if we do, interest rates are going to go up. So what's happening right now is that we really aren't seeing a lot of inflation, which is good, and interest rates have pretty much been stuck below 3%. So wake me up when they get to 4% is what I kind of think about. But it is interesting to note. Now, the rich, they get richer, and the poor get the blame. So you ask the question, how come the rich get richer? And it's very simple. They have capital, and they invest their capital properly. So the question you have to ask yourself, and you really want to ask your children, do you have capital? Are you accumulating capital? Because the only way the rich get richer is that they have capital. The poor get poorer because they don't have capital, they don't invest, and inflation just eats away at their lifestyle. So, are we possibly involved here in a bull market that could change our lives? If this pattern that I'm going to describe to you repeats, this will be my last bull market. I'll be 64 years old in September. And I have finally accumulated enough capital that if I do get a bull market, it's really going to make a big difference in my life. And what you have to understand about money is money solves problems. Now, I call money capital. Capital solves problems. If you have a legal problem, or you have a medical problem, or you have children that need to be educated, you need capital. And so what we have to do is we have to discipline ourselves to accumulate capital. So let's go back and look at a situation here. This is 1985 through 1991. Now, I don't know if anybody remembers, but we had the crash of 87 in here, which was a major panic. So the basic rule here is that difficult markets are usually followed by easier markets. So in this particular situation, and like I say, this would have been a great time to be accumulating capital. Let's just say you put away $10,000 a year over this time period. Well, at the end, end of 6 years, you've got $60,000, and then you've got capital. If it's in the market, and let's say it's in the NASDAQ, because this is the NASDAQ, then you get to see a major bull market. So we had 27 quarters of difficult market, what we call consolidation. Market didn't go anywhere. This was very frustrating. Most people, they can't handle this. They cannot handle a crash of 87. They can only handle the bull market. And what I found from my experience is that most people start coming into the bull market up here. And then they get burned, and we go into a bear market, and then they start screaming about how Wall Street is a bunch of crooks and so forth, which they just did not have the discipline to accumulate the capital during a difficult market. So we went 27 quarters, or 6 years. Then we went up for 34 quarters. And if you look at where the market broke out, the NASDAQ broke out right here in 1991 at 500. And then by 2000, it was at 5,000. So if you were able to sock away $60,000 in here, by here you've got $600,000. Now, we're not doing anything slick here. All we're doing in these boxes, these consolidation periods, is this. If you can find periods of time where you can draw a horizontal line, that's usually a consolidation period. So if you go back and look at the last 20 years, we peaked in 2000, just like we peaked in 1929, or we peaked in other periods. Then we had a bear market, very difficult, incredibly difficult. Then we rallied, and then we had another bear market, which was very difficult. Then we've gotten back up to the top end, and we were getting ready to make a new high in the NASDAQ, and then we got back into another little difficult period here, which started around 2014. And then all of a sudden, around May of June of 2016, this thing started to break out. So here we are. We've got a base of 20 years, which is 82 quarters. Now remember, back here it was 27 quarters. This has been 82 quarters. And so, we then rallied for 34 quarters. We are only 1.5 years or 6 quarters into this current breakout. So we just kind of have to use our imagination a little bit, and you have to ask the question, could this be an opportunity of a lifetime? Is this my last bull market? So this has been a great time to accumulate capital. If you haven't accumulated any in here and then it starts to break out, or if you already have capital, you're in great shape. But if you haven't accumulated any capital in here, and you probably haven't because you've been so fearful of the market. So there's been 20 years of fear. Back here was 9 years of greed. So you then just kind of have to, realize that this could be an opportunity of a lifetime. So as a registered investment advisor, I could sit there and tell people, nothing good's ever going to happen. This is going to turn out bad, just like this turned out bad, and this turned out bad, and then this turned out bad. But the fact that we have broken out of a 20-year or 82-quarter difficult period, are we going to get 5 years of good? Are we going to get 10 years of good? You might get 30 years of good. So the main thing is just stay disciplined and realize that this is the time to really sit back and grow your portfolio. So let's look at the top 5. Now there's been a lot of turnover in the in the market. We're seeing a lot less interest, and we're seeing some deterioration in technology. But at the same time, we're picking up on more consumer discretionary type stocks. So if you go back and remember the first graph where we talked about low unemployment, people that did not have a job 5 years ago, because the unemployment rate 5 years ago was up around 10%. If you didn't have a job, you couldn't go out to a restaurant, or you couldn't buy the new dress or whatever. So consumer discretionary stocks are acting really well here. But here's the number one stock on the top five, a Biomed, which is medical equipment. We're seeing a lot of medical. Here's an internet stock called Carvana, fairly new company. They're involved in buying used automobiles over the internet. It's kind of a slick deal. Here's another medical stock, medical equipment, Foundation Medical, major breakout on earnings. Here's our old friend Netflix. Again, here's another consumer discretionary. You know, when everybody has a job, they're probably going to get their Netflix. Here's another medical called Sarepta Therapeutics. Again, there's a lot going on with biotechnology. There's a lot happening with the cure of cancers. And this group has been very strong. So in summary, and I apologize for the length of the video, you've got to understand that when the markets are difficult, that is when you really need to be putting money into the market and not pulling money out of the market. But it's very hard to discipline yourself, but that's what it takes to get richer. Thank you.